I look at your portfolio, Dave. You have a total of 6% invested in US equities. Now, that's a fraction of what most other global investors have in US equities because it constitutes in excess of 50% of the market capitalization of world equities. I've often heard you say that the US is a great place to live, but a terrible place to invest. Run us through your thinking here, Dave.
And all of us are looking for quality, and that is a great first step. Sometimes, now included, people forget equally important second step. What is the price? So I love the U.S. I've lived there. We've done great. I think we will do great. Should be a great place to be. But everything comes at a price. Right now, the U.S. market is as expensive as it's ever been on a lot of metrics, and certainly in the top 2 or 3 or so. We like the U.S. It's just that these valuations, things may or may not be difficult. More importantly, it's a big world. A lot of great companies, a lot of great countries. We think a lot of money can be made outside the U.S., and hence we'll leave the U.S. to other people for now. Sometimes, now included, people forget equally important second step. What is the price?
As 2 of the best stock pickers around the world, there's not one common stock between your 2 portfolios. So tell us why that is.
At Sands, what we're looking for are businesses that are something today, but we see something in that business, we think it can be something very different in the future. That's what a growth investor does. A value investor is generally looking for something today that is something, but is trading at a price well below what they think that is worth, and they think that gap might close over time. Neither one of those is better or worse than the other. They're just different. But when you apply those 2 different mindsets and you go out into the world of investable opportunities, you come back with a completely different set of companies. The role of numbers and spreadsheets and precision in our industry it's ridiculously overstated. And the longer I do this, the more I conclude that investing is a lot more about the people that work together to make the judgments on what to invest in and what not to invest in than it is about the precision or the numbers that you put in a spreadsheet somewhere.
Dave, let's keep on top-level risks for portfolio analysis. There's a risk measure called active share. Your active share is 99%. That means, in English, that you look absolutely nothing like the benchmark. Out of 2,500 stocks in the MSCI All Countries World Index, is there not one stock that you can find that's interesting?
Yeah, always a great question. Indexes are an example of a very good idea that when it becomes too big, becomes a very bad idea. And to talk about that, if a lot of us are doing analysis, then replicating what everybody's doing makes a lot of sense. When everybody starts pouring their money into the index and no one's doing the analysis anymore, that's a great time to be some of the few people that are still doing the analysis. So if money's going to index, great. When more money's pouring in the index, that means the stocks in the index start going up faster than the stocks that are not in the index. We saw this in the 1990s, the last time us active managers were extinct. And what happens eventually is the index no longer represents the market.
What constitutes risk for you, and how do you mitigate against it?
For long-term investors, risk, in our opinion, is permanent loss of capital. If the stock goes down, never comes back, you've lost money permanently. If it's going from here to here, volatility really doesn't matter for those with a long-term horizon.
And one way to think about it is that your risk management framework ought to match up with and be consistent with your investment framework. So if you truly have a long-term investment framework, the wiggles along the way in the stock price shouldn't matter. You should worry about what you pay for it. You should worry about what you sell it. Long-term investors should view volatility as a source of opportunity, not a source of risk.
So, I mean, you mentioned in your in your talk that you've got 38 companies, stocks in your portfolio. The question really is that a prudent way to manage money? 38 stocks out of, once again, 2,500 in the benchmark. Is that prudent?
Look, it's the top, 30 or so things that drive most of the performance anyway. Why do we own the rest of that stuff? I'm not diversifying when I own 100, 200, 300 stocks. I'm diversifying. And so isn't it a better investment proposition if I'm after long-term results to own more of the best things I can find rather than dilute all of my research and own incrementally worse and worse investments.
So as a value investor, I would assume that there must be cheap companies in emerging markets. As a growth investor, I would have to assume that there was a lot of earnings growth from companies in emerging markets. So Dave, let's start with you. Which is it?
To us, growth is a wonderful attribute. We should all be attracted to that. Value is prerequisite to us. So why ever overpay for something? So we're looking for value. Growth increases the value. Occasionally, you can find growth and value in the same place, usually after corrections like 2002 for technology. It was interesting, 6 or 7 years ago, people said, you must own the emerging markets. That's where the growth is, that's where the value is. They were right about the growth, wrong about the value. Now the value's there. So you can have growth and you can have value in emerging markets. It's the most attractive place in the world to us right now.
14% of your 30% ownership in emerging markets is in Russia. There's significant political and corporate governance issues with Russia in general. So what attracts you to Russia as an investment destination?
Got a lot of bad things. It's got a lot of good things. We don't buy countries, we buy companies. So we happened on the biggest, longest-lived oil or gas company in the world at about a 95% discount to what it would cost if it was anywhere else. We own some good utilities that are cheaper than anything else, a good drug distribution company, a strong bank with 20% ROE. They just happen to be in Russia. Because they're in Russia, we would rather not own them. We want a 50% discount. The market says 50%, we'll give you 70, 80, 90% discount. We say done.
I'm not sure you're going to match that answer, Suni, but we're going to give you we're going to give you 30 seconds on India because you've got 14% in India.
It's a fascinating investment destination for a growth investor because you have that combination of a nice underlying economic tailwind, which is driving growth across a range of industries. You have personal disposable income rising at an even faster rate than overall GDP, and that's leading to mid-teens, low 20s earnings growth from everything in the banking sector to a number of different consumer products. And so whether it's paints or whether it's motorcycles or whether it's getting a credit card and a bank account, all of that or a mortgage are just growing very well. And the other thing that we really like about India, and this isn't true universally through the stack, but you find in that top echelon of Indian companies, they have as good a corporate governance and as good a management as any company anywhere in the world.
You currently have 30% of the portfolio in technology.
That's a risk. The beauty of technology is you have some very fast growth businesses. The challenge in technology is half the reason those businesses are growing so fast is because they are very quickly disintermediating some other technology that came before it. What you want to do in technology is figure out where the choke points are, figure out where the real sustainable competitive advantages that are going to last through multiple generations of technology are, and then try and invest in those areas. And so today, those areas we think are things like Amazon.com. Do you consider it consumer? Do you consider it technology? You could kind of go either way, but at the end of the day, it's just a platform. They don't really care what products they sell. The retailers that sell on Amazon will come and go. We're not betting on the customers, we're betting on the platform.
From technology to resources, 40% of your portfolio, resources, predominantly precious metals and energy. In a world dominated by tech, is this even still relevant, Dave?
The good thing about the boring stuff we own is 5, 10, 15, 20 years from now, I will go out on a limb and predict that we're all still going to consume food. And we're likely to want to consume energy, I think electricity, I think resources are here to stay. So we don't know if you worry about it. There's less risk, and they hold value too. The thing is people will spend lots and lots of money looking for these commodities. For I think every 3,000 people searching for a gold mine, one person ends up with a mine, and usually they're not economic. They pour $1 billion into building this mine, and my job is to sit and wait and wait and wait and wait, and sometime in the next 10 years, the market says, that $1 billion mine, you can have it for $100 million. Once again, we say, done.